Welcome to our 2023 Fintech Effect Tech Talk. So imagine your Spotify wrapped playlist, but for fintech. But hopefully this will be less predictable than seeing Taylor Swift sitting at the top of my playlist. My name is Raja Chakravorty, and I'm the head of Universal Access at Plaid. At Plaid, we envision an expansive view of the open finance world where all consumers are owners of their financial data. Now, the ownership of data means that financial data should flow in a multi-directional fashion between data providers and data recipients as directed by the consumer. And universal access enables consumer connectivity for financial information wherever that information sits. You can think about financial institutions of all sizes to technology providers like fintechs, neobanks, digital banking platforms, and really everything in between. So I have the great fortune to host our last Tech Talk of 2023 with you all this morning. And I'm thrilled to be joined by my esteemed colleagues, Michelle and John, for this talk. So let me go ahead and pass the mic to them to introduce themselves. Michelle, please take it away.
Awesome. Thanks, Raja. Michelle Boros. I am a product lead here at Plaid, focusing on our credit products. Super excited to be here today, talk about some great things going on in fintech. Taylor Swift is not at the top of my Spotify rap playlist, but no judgment, Raja.
And I'm John Pitts. I'm the head of policy for Plaid. I do all of our advocacy on consumer data access rights and other issues. Top of my Spotify Wrapped was Baby Shark, as it was for almost every American. But unlike most people with Baby Shark at the top, I do not have young children. That is just me listening to Baby Shark on repeat because it's such a hot jam.
I can't wait for us to compare our Spotify Wrapped and see who wins. Like, there should be a stack ranking. I'm sure mine will be the top. I digress. As you may know, the latest edition of Plaid's Fintech Effect just dropped a few days ago, and I definitely can't wait to dive into the latest findings and biggest takeaways. And Michelle and John, I can't wait to hear what you guys have to say. Please be spicy, not medium spicy, like hot spicy. That'll be ideal. For those of you who may not know, over the last 4 years, Plaid has worked with the Harris Poll on a broad consumer survey about fintech. Now, the results are published in an annual report called the Fintech Effect, which pulls together insights and analysis about fintech's impact on consumer financial behaviors and outcomes, as well as consumer perceptions and expectations of digital finance. Now, in 2021, the Fintech Effect highlighted fintech's mass adoption when 8 in 10 Americans were using fintech. Since then, we've just seen a deepening of use cases, going across age ranges, going across demographic lines. But with this increased utilization has come nuance in how people use fintech and what their expectations would be from this type of technology. So I'm excited to dive in here. But just for everyone to know, before we get started, there's just a couple things to know. There's a Q&A widget at the bottom of the screen. So anytime if you want to drop in your questions, feel free to do that. We'll definitely try to address those at the end of the session. And we'll also share a recording of this session via email following today's Tech Talk. So with that, let's go ahead and get started. So the first insight, fintechs for the win. Okay, so 84% of consumers say they're better off thanks to fintech. I know we have a couple other stats that were presented. The first was 34% of consumers used 3 to 5 apps, which is up 4% since 2021. And that the number of those using 6+ apps is projected to jump to 20% within the next 6 months. So Michelle, from your perspective, like, what does app usage, especially that 3 to 5 apps per consumer, mean for the fintech roadmap? And in addition to that, like, given the 6+ apps is projected to increase significantly, what can fintechs do to meet the demand of more tech-savvy consumers?
Look, from a product perspective, it's all about doubling down on the value proposition. To do things like help consumers manage their money or improve their financial outlook, and build out the differentiation of your products to really create stickiness with the customers. And as that number of applications scales up to 6, it's about becoming more competitive. It's going to be more important than ever to diversify the needs and making sure that you've got different product sets that really make your app the most important app for consumers to want to use, and really improving that overall customer LTV.
Yeah, totally. from my perspective, it's been a fascinating year in the world of universal access. I mean, we've heard more and more from credit unions, community banks, and financial institutions with kind of more specialized consumer bases that their consumers need and want access to emerging fintechs, particularly around payment and access to credit. And we've also been hearing more and more from fintechs that want their consumers to be able to connect those accounts directly to other fintechs or to other banks because their consumers are asking for it. I think at the same time, we're seeing evolving tools, evolving needs that these tools have to offer. Like, for example, we're seeing cost of living increases that are actually driving consumer needs to have just better tools around like savings and spend management. So John, I know that this is going to be hard for you because you typically like to filter everything you talk about, but I'd love to get your unfiltered take on the state of digital finance. I mean, despite this, what we'd probably describe as a rough year for consumers and fintechs.
Yeah, I'm going to provide a very cautious, filtered answer here because that's what the people demand. No, let me just go at it with like what I think are a couple of really important truths here that don't often get spoken. So when you say that like it was a rough year for fintechs, I actually think that from a consumer point of view, that's absolutely not the case. And those numbers in the Fintech Effect show it, right? Consumer use of fintech has continued to grow. What has been rough is that like it turns out that when Jerome Powell raises rates, money is less free, and that means business models can be under stress. So like, yes, there has been stress in fintech business models over the last 18 months or so, but consumers have continued to rely on fintech more and more. And actually the shift to digital financial services that fintechs are offering is accelerating, if anything. So from a product perspective, fintechs are becoming more and more essential. And I think the number one proof point for that is how the federal government is starting to respond, because government moves slowly. They only move on something when they really think this is not a temporary thing. This is a permanent state of affairs. And between the CFPB's Dodd-Frank rulemaking, the Federal Reserve's creation of a special supervisory body just to deal with emerging issues like crypto, the emergence of FedNow, the OCC ramping up banking as a service oversight, all of that is because a bunch of very serious, sort of careful thinking people have looked at the landscape of consumers and said, fintech and digital financial services is a permanent part of that landscape. And I guess the important sort of thing to add on to that is going to create a new level of test for fintechs in the future, which is as more and more regulation happens, because people take fintech more and more seriously as an essential part of consumer financial services, is your business as successful at navigating those regulatory requirements as it has been in navigating product and product market fit, UX, all of those things that made you great over the last couple of years? You're going to need to be just as excellent at them and excellent at the regulatory world, because the government is taking you seriously, because consumers have taken you seriously, and because consumers have voted with their thumbs that this is what they want the future of financial services to look like.
Yeah, and John, I mean, you're Plaid's global head of policy. So did I hear you correctly in saying that you actually are expecting that regulators are going to move faster than they were before?
Absolutely. Yeah. I mean, I think the sort of critical mass of fintech has been reached. And so that means that like once that machine gets in motion, it doesn't stop easily. It's got some inertia behind it. And so, you see this with the SEC, you see it with the CFTC, you see across the board in Washington, D.C., more and more resources are being put into fintech and what the right sort of consumer protections and financial oversight looks like for the market. And I think the right way to view that is that is a vote of confidence that fintech is something that everyone's going to be engaging with from now on.
Yeah, super fascinating. Well, all right, let's go ahead and transition to our next insight. So, okay, credit score Schmedit score. Did I pronounce that right? Schmedit score. All right, well, let's get some spice up on this and we can increase our Reddit scores. How's that? Okay, so 63% of consumers believe traditional credit scores fail to capture their complete financial narrative. Okay, look, so some of the underlying stats here that 60% feel sharing banking data could paint a more accurate financial portrait. And for millennials, that jumps up to 70%. I mean, I might just go ahead and start here. I mean, this insight, like I'm going to quote my friend Craig Lewis. He's the CEO of a company called GigWage. We did a panel together a couple years back. And what he said is, no matter how you slice it, the same people keep getting left out of the same shit. I mean, like from my perspective, this is literally the power of data, right? The opportunity ahead is vast. I think fintechs are considering data capture through a wide array of assets. Like universal asset access, my surface area really enables this. Data is generated in new and unique cases and can be used by consumers to help build other use cases. And we see this in financial management. We are also starting to see this in underwriting. And honestly, it's not just financial data. I mean, take telematics, for example. So I don't know if anyone here finds auto insurance riveting, but imagine the ability to capture data signals through a mobile device that actually reflect how good of a driver you are. And now couple that with your ability to repay and attach the risk factors together to financial factors. And that's kind of the future, right? Like, how do you start appending like all of these different areas of data together to get something better? So look, there's clearly a ton of new data generated here that can be used for more innovative ways to meet consumers where they are. But John, I mean, listen, with a clear trend towards consumer data sharing for better financial services, I mean, what should be done under this guise to balance advocacy for these use cases with crucial needs like for things like data privacy?
So I think the most important thing is to really emphasize the consumer being in control. Because if you think about sort of the traditional credit underwriting and credit reporting world, one of the biggest complaints, and this goes back to when I was at the CFPB and then Director Cordray talked about consumers getting caught in dead ends, right? Where they're not in control. The information that a credit bureau has on them or is providing to a lender isn't something they understand. They don't know all of it. They may not think it's accurate, but they might really not even have a way of seeing it. And there's different credit reports that go out to different people. That's a huge source of consumer frustration. And I think one of the things that's amazing about open banking and the consumer data access right that comes with that is consumers really have an opportunity for a different dynamic where they know what data they are sharing. Knowing what data you are sharing also gives the opportunity to really build privacy controls in for the consumer as part of that control. Who do I want to share it with? What am I comfortable with them using it for? How long do I want them to have it? All of those things are things that you can do with consumer-centered data sharing that you haven't been able to do with traditional credit reporting in the past. I think that's sort of the secret sauce of what we can do here. I also think it balances, as you say, Raja, that advocacy for consumers to have this right with also making sure the privacy controls are there. Give the controls to the consumer. Let them decide what they want to do with their data. Yeah,
absolutely. I mean, Michelle, look, like given that 60% of consumers are open to sharing this banking data for that more accurate financial portrait, I mean, I'm curious, like, how is this influencing Plaid's credit product? Like, are there any new innovations underway in reflection to this?
Sure. Before I get into that, I just have to say I love this stat and I would upvote it on Reddit for you, Raja. I think this is a great one. Let's talk a little bit about context around credit score before we hop into things we're doing here at Plaid. I'm going to channel my inner John Pitts and give a little history shout out right now. So look, credit scores have been the gold standard since 1950s. And if you think about it, a lot has changed in this world since 1950s. And from a credit perspective, there's been advancements in technology, there's been changes in consumer behaviors, how they're paid, how they operate. The world looks very different. And so I guess the biggest question is, why is credit risk still, or why is a credit score still a main measurement of credit risk? And don't get me wrong, I think credit scores are a really accurate representation of a borrower's willingness to repay. But I think there's more to the consumer story that's not being told. And I think we're seeing that as part of them wanting to share more data. In terms of what Plaid is doing, I'm excited to share that last month we announced the launch of Plaid's consumer reporting agency entity. What that's going to allow us to do is ship new products and services. They're really around cash flow based insights. And we believe that these insights are not necessarily the next credit score from that point of view, but it's also something that can work in a complement or as an alternative for those that are currently overlooked by the credit ecosystem, like the 50 million Americans that are credit thin file. And so with consumers more willing to share their bank data, it's more important than ever that cash flow is another alternative that's looked at that can be really the ability to not just drive better approval rates for a borrower, but it also drives things like what offer they get, what interest rate they get, what loan programs that they qualify for. And with interest rates where they are now, it's more important than ever for us to really think about how this can impact consumers.
That's awesome to hear, Michelle. And if I'm hearing you correctly, you're saying like fintechs, they really should be adapting their credit products to take into account things like cash flow based underwriting.
Absolutely. And not just fintechs, everybody who's underwriting loans.
That's great. All right. Well, let's move on to the next insight then. All right. So effectively, consumers are just getting more comfortable with non-traditional providers. I mean, while large national banks still hold a strong comfort level, I think it's 87% now. Fintech companies are now having a 79% comfort level. So we're actually signaling a narrowing of the trust gap. As we're kind of talking about consumers and thinking a little bit about this transition, if you'll bear with me, I just saw that Oxford Dictionary's word of the year is Riz, something like that. Are you guys aware of this? Have you seen this?
I think it's Riz.
Riz.
Okay. Very aware of it and would be perfectly happy if you refer to me as the Rizzler for the remainder of this conversation.
Okay, we'll see about that. But okay, so for the audience, if they don't know what it means, I looked at the definition. It says it's a slang term for style, charm, or attractiveness, an ability to attract a romantic partner, or a short word for charisma. So here's a question for you guys. Can we just say that fintechs got Riz? Okay, well.
Did you actually need us to vote on that? Like, I'm happy to vote. I think saying fintechs have Riz is bussin', Raja.
Coming from the Rizzler himself.
Coming straight from the Rizzler. All right. if one of you guys can incorporate, the first one rather to incorporate Riz into their answer and it actually makes sense, I will go ahead and Venmo $5 after this. So, okay, let's get back on track. Apologies for taking us off. Look, I think one of the strongest concepts we're seeing in universal access, kind of related to this topic, is the idea of building primacy to the account. So if you can transact directly from it, it becomes top of mind. So account connectivity for fintechs seems critical for this kind of trust building here. A consumer can transact directly from that account right into the next thing they want to do. Don't need to transfer funds away to do that thing. So connecting disparate apps through a trusted medium also drives trust. Going through similar linking experiences, authenticating and verifying identity the same way. I mean, these all increase trust. So Michelle, I'm curious from your perspective, like what can fintechs do to capitalize on this trend? Like in which ways do products need to evolve to further close that gap?
Okay, I think there's two ways to look at this. It's that fintechs now have this opportunity to increase and take over what's traditionally been a bank-focused thing, or that banks themselves have the opportunity to continue to innovate and play in the space. Either way, consumers are expecting speed, efficiency, instant experiences like they're used to in everyday life. And those expectations extend beyond, just day-to-day applications that you use, but also the type of experiences that you're getting for financial products. And so both fintechs and banks, they really need to think about how do they capitalize on this trend? How do they invest in things like onboarding a customer faster, funding an account at opening instantly? And it's all about optimizing that value in order to ensure that the value proposition you're offering their customers makes you, the service that they're going after.
Yeah, definitely. The Rizzler. So from your perspective, like,
yes, it's happening.
Just how important is this for fintechs today? Like, what needs to be done to continue to build trust, and why is timing really important here?
So Catherine said she's going to steal voting with their thumbs from me. It's actually not mine, Catherine. It was Seema Gandhi, who used to work at Plaid, who's the first person I heard that from. So feel free to steal it. Also, I'm going to steal something that I think I'm attributing to the right person, but I'll say it first, which is the battle between every startup and incumbent comes down to whether the startup gets distribution before the incumbent gets innovation. And that's a Andreessen Horowitz quote, or at least that's the place I've seen it before. I think it's right. And the reason that's relevant here is one of the things that traditional FIs have that I would argue is part of their distribution is trust. It is the trust that over several centuries, in some cases, they have built up with their consumer base that lets people be really comfortable opening a bank account with a bank that isn't in their state, right? They're doing it online because they fundamentally trust that institution. Fintechs have made incredible strides over the last couple of years in building up a similar level of trust, but it's not quite there yet, right? You don't have the distribution and the trust nationally, globally, that traditional FIs have been able to build up over centuries. And it's not surprising. Many of you are, not centuries old, you're decades old. The thing to understand is that fintech has been so successful that those traditional FIs, they are starting to innovate. They are building out really good, innovative solutions. They are seeing what you are doing that they think works and that consumers like, and they are being forced to adapt and bring it to market themselves. And so in that race between distribution and innovation, they're starting to do the innovating. And you have to have that in mind. And your number one sort of goal should be, what's the distribution we need to be successful once other people start innovating? And I do genuinely think that trust, that consumer willingness to say, you're a recognized brand. I understand what you stand for. I understand how you're going to treat my data. I understand that your products are good, reliable products that I believe in, is the last gap to close to ensure that you can continue to compete and take market share away from your competitors and the traditional incumbents, because it gives you that scale and advantage that they have in terms of what your total market is.
Yeah, makes a lot of sense. All right. I think we're ready. Let's go ahead and take ourselves to the next insight. Okay. I think this is actually fascinating to see, but we saw that nearly 70% of consumers are open to pay by bank, even when credit and debit cards are an option. I think this is a big change. I think some of the underlying insights that we found is that is actually notably higher among fintech users. It's almost 72%, and millennials, which is close to 3/4 of millennials. 51% have used bank payments over cards in the last year. Again, that's higher among fintech users and millennials as well. And largely what we're hearing is that the top benefits of this pay by bank, according to consumers, are around convenience, security, and fewer fees. So, John, I'm curious. Actually, John, are you okay if I go back to John, or do you want me to stick with the Rizzler? I think you're on mute. That was a very Rizzy thing to do, to keep yourself on mute.
He's speechless.
Okay. We might have a little bit of a gap in timeline with John. Just holler.
Nope, I think I'm good.
There you are.
Yep.
All right.
Sorry, I was responding to someone in chat with a link to Alex Rampell's blog post on distribution versus innovation, and trying to do two things at once, as someone with Riz does regularly.
That's like you just brought the Rizzle Dizzle.
Yeah.
Yeah. There we go. Okay. So let me kind of reiterate the question, but
you don't need to reiterate, because I actually want to engage chat here again, because I've seen that we've got a couple of people from the Fed on board. And could everyone please use your emojis or just chat to say a gigantic thank you to the Federal Reserve for launching FedNow and bringing that to market, because FedNow is the absolute sauce, right? Like, this is the thing that, there we go. Look at that. That is absolutely fantastic. Consumers have been looking for ways to seamlessly send money for a long time. And there are a number of solutions that have come to market to solve that problem. And the dirty reality is, in the United States, that is card rails that are solving that problem, or closed loop networks. And the reason they are the ones solving that problem is because our underlying infrastructure, the ACH payment system, is from the 1970s and is behind the rest of the world in terms of being able to deliver reliable, low-cost transfer of funds. And every merchant has to deal with that. Every consumer has to deal with it. It is the structure of our country. And between the clearinghouse launching RTP and the Fed launching FedNow, we now have two real-time payment rails in this country. And I think the opportunity that is presented by that infrastructure upgrade is unbelievable. And to get back to sort of the core of your question, so that I'm not just like gushing about massive infrastructure upgrades, like, this is now essential for you as a financial services provider. If you are not thinking about how you are going to take advantage of the fact that your customer can move money faster and cheaper than they have ever been able to do before, you are thinking about a 1970 solution for your product, not a 2025 solution for your product. So I would say this is essential. This is the core of what people should be thinking about today.
That's interesting. I mean, I'm not going to directly disagree. I think that from my perspective, look, when I think about like the old days, right, of pay by bank, I mean, that required the need to type an account and routing number, which had, one, like a ton of friction. And two, I think just like a general perception of just a higher risk factor than a credit card, right? Now, I think connectivity has enabled people to connect their primary account once, and then use kind of like these high security factors for authenticating their identities, and then subsequently authorizing the places they want their funds deployed in more of a seamless kind of fashion. But I'm still kind of curious, is it really going to feel as seamless as, kind of some of those one-click credit card experiences you might know? So I think that's a question that I think needs to be solved. And I think then it will definitely be an area to move forward. But the other piece that's kind of interesting to me is, it seems like it actually opens up the ability to pay in places that pay by bank may have before not been as highly utilized. Like before, it was very much utilized at recurring billing types of options or utilities. But it feels like there's a massive opportunity to now lever these new infrastructures into many different types of payments as well. So I think maybe Michelle would love kind of your perspective, like, where's payments at today? I mean, what does this finding mean for the road ahead? And what do you think it means for credit just broadly?
Yes, I mean, as you guys both talked about, we're seeing a directional shift in payments. My somewhat spicy take is, I don't think we can hold all payments equal. I think if you look at a payment for a $50 concert ticket, it looks really different to a consumer than a payment for a Tesla. And so, understanding that impact of consumer behavior, what's the size of the payment? What's the frequency of the payment? What is the payment for? I think that really drives the need for optionality. And I think it's important to evolve what's presented to a consumer, how they can actually convert in that experience. Is it as delightful as a quick and easy credit card or debit card payment, but really fitting it into the need of what types of use cases, what types of payments are actually being made. And from a credit perspective, I do think that, we're going to continue to see a lot around recurring payments and the way that people are paying their loan payments. And so I'm excited about this change. It's a really cool stat to see, especially as, the infrastructure is getting us to a place where we can actually really create change.
Yeah. And from your perspective, do you feel like the infrastructure is there, or do we still need to do a little more work to get there?
I think there's
I
exciting things that Plaid can do in terms of making this a delightful experience for consumers. John talked a little bit about what's happening, in terms of the ability to actually enable this. And so I'm excited about the work that the team at Plaid is doing to be able to create a better experience around this for consumers.
That's great. Well, I, for one, am definitely excited to see how this evolves. All right, so let's move on to the next insight. Okay, I think we may be coming to the end of insights, but of course we got to talk about AI, right? So consumers are ready for AI to revolutionize the way they manage money, but there's some conditions to it. Okay, so I think some of the stats underlying here is that 60% of consumers actually believe that this is going to be the case over the next 5 years. They see that some of the biggest potential is in lowering bills, helping solve customer service issues, provide budgeting advice, manage subscriptions, offering financial education, streamlining tax filings. I mean, there's a lot of use cases that I think consumers are starting to see here. But the reality is, like, while 60% want fintech apps to use AI for that more personalized approach, I think most Americans are not ready for a fully automated future. And in fact, 3/4 of Americans would prefer to review AI's financial decisions before entrusting it to make decisions on their behalf. That's kind of the one caveat. And the second one is that 7 out of 10 want to see regulation around AI in general. And so, John, I know you love regulation. In what ways do you think we can expect to see policy shape AI and the way consumers interact with it? And really, I think particularly for our audience, are there things that fintechs need to do to kind of get ahead of this?
Yeah, and I love regulation, and I hate to be put in a wet blanket role, but I'm going to be a little bit wet blanket here on this answer, right? Which is the thing that fintechs need to understand and get ahead of is that fundamentally they are in the financial services business, and new technology rolls out in financial services very differently than it rolls out in other parts of the tech sector. So let me just give you an example. I used to be at the CFPB. When I was at the CFPB, in the 20 teens, we were working on a rulemaking that would clarify that you can use email to do debt collection. Now, the existing debt collection rules had very specific regulations on how you could use telegraphs to collect debt. But because they were last updated in the 1970s, there was nothing about email. And even voicemails was something that was like backed in through court decisions. So it can be very slow to adopt new technology into financial regulation. And in general, when it's financial services, the answer is you cannot use the new technology until you have permission, rather than go ahead and use the technology until we see how it works or doesn't work. So on AI, I think everyone needs to have an understanding that wherever else it gets adopted, it's going to be slow moving from a regulatory perspective in financial services. But there are a couple of things I think you can think of ahead of time. The first, and I think the most important, is that no one is going to view the computer did it, not me, as an excuse. So if you implement AI to speed up a process, let's say underwriting, and it turns out that the AI underwrites loans in a discriminatory way, I'm sorry, that was not the AI that did discrimination, it was you that did discrimination. And so you need to deeply understand how AI is being implemented into your business, whether it is touching on a regulated product or whether it is doing something like smoothing customer service interaction. But even in that customer interaction, if you get one of those chat GPTs that hallucinates an answer for you and it is deemed to be deceptive to the consumer, you have just accomplished a UDAP for yourself, and you are now going to get an enforcement action as a result of it. So it's a really exciting technology, but it's one where the regulators are very focused, and the baseline assumption is going to be anything that goes wrong in the AI is something that you have done wrong, and there's not going to be a lot of margin for it. So make sure you remember that even though other people can do it, you still might not be able to.
That's fascinating. By the way, you saying that you said the concept around AI hallucinating an answer makes me think like you could prompt an AI to say, act like you are ingesting hallucinogenic materials. And I feel like that could be just a fun Friday night to see what it spits out.
I mean, to be clear, as of now, Fintech Effect does not have an official position on the use of hallucinogens for consumer financial services. So we'll have to wait until next year for that answer, Raja.
Okay, I think that should definitely be an insight coming out of 2024. Everyone stay tuned for that. It's going to be great. All right, Michelle, from your perspective, I mean, John talked about some of the policy and some of the limitations, but I'm curious, like, what do you think fintechs can do today with AI? And I mean, there's probably an implication here on like what roles they should be hiring for too.
Yeah. I mean, look, I do agree with John. I think underwriting and decisioning alone is going to be really challenging to use AI. And we saw that in the survey. Like, consumers are super excited about this opportunity that AI can bring and can help you better understand your money. It can create the ability to make better decisions. But they also want to know that there's checks and balances, that there's someone behind the decisions that are being made, especially things as important as standing in the way of you buying your first home. And so as much as I agree that AI shouldn't be used for decision making, I think that there is a lot of benefits in terms of how AI can power efficiencies, how it's the ability to better understand data for lenders, or do things like automate or intelligently drive product workflows that have traditionally been really manual and prone to human error. And I do believe that machine learning and AI can help build better models, build the ability to drive these workflows, and in turn pass on benefits to consumers, help them get into better products, help them serve their needs faster. But again, it does have to come in those checks and balances. And there's a place where it's the right place. And there's also the place where maybe it's a not yet. I'm sure the Telegram never thought that it was going to be replaced by an email, but there's always opportunities. And then to your point on hiring, like, I think, both fintechs, lenders of all sizes, investing in the ability to, focus on insights-based products, whether or not it's something that you get from a partner, or is it something that you hire and have resources in-house that's really building out that differentiation for you that makes your process unique.
Yeah, definitely. I mean, I'm curious for both of you, how much of your responses were just written by AI?
I am the AI.
Yeah, I mean, this isn't even my actual face.
I agree. I think I like it better. Okay. Yeah, I think, one of the things, Michelle, I really like kind of what you said. One of the things that really resonates for me is this power in helping consumer education. So we've been talking about, the mass adoption of fintech. That was part of like one of the big insights we saw a couple of years back, that deepening of usage. I mean, I think fintech gives consumers the power to do a lot, but is it Uncle Ben who said, with great power comes a modicum of responsibility? And so, like, how can a consumer responsibly take advantage of the tools fintech has to offer? And I think it has been really important for fintechs to invest in education of the products, because now consumers can directly access those products. But each consumer is different. They're viewing the utility that is provided by the service differently based off of their own specific outcomes. And so being able to prompt AI in context feels like a really valuable sort of tool that allows kind of like this dynamic incorporation to help consumers get the best, most effective use out of these apps. So listen, I mean, I talked a little bit about what was prompted by AI. That was almost all AI on my end, but I actually just, while we were talking, prompted AI to give us a short rhyming wrap up of this specific outcome. And I'm going to read 2 lines of it because I have the microphone and I'm not allowed to. So it starts like this: as we close this fintech tale, a journey where tech and finance sail. We've explored, discussed, and seen how digital threads weave the finance scene. I think that's pretty good. That's pretty good.
10 out of 10.
Yeah. I probably don't need to, I can just do this for my job going forward. This is amazing. Okay, great. Well, I think that is the last of the insights. Listen, so we covered 5 of the biggest takeaways from this year's FinTech Effect report. But to hear what today's consumers have to say about everything from crypto to inflation to their financial goals for 2024, including what they most need from fintechs, be sure to download the full report. We'll make sure to drop a link in the chat. But right now, oh, there we are. Thank you, Cody. We are excited to dive into the Q&A. So with that, as a reminder, you can use the Q&A widget at the bottom of the screen to submit your questions. All right, great. So let me go ahead and start. Okay. First question. So this was great. Big opportunities for fintechs in 2024. Will Zach be making his prediction for 2024? I will answer this. Yes, Zach is going to be making his fintech predictions. It's in January. Please look for more information on that very soon. Hopefully it brings at least as much spice as we talked about today. Okay, the next question. You know what, Michelle, I think I'm gonna direct this one to you. So in Plaid's new Credit Insights product, will there be opportunities for consumers to manage and control the data they share, or even correct it if inaccurate?
It's a great question. I talked a little bit about the launch of our consumer reporting agency entity. As part of that, we will have consumer report products. Stay tuned for a little bit more information on that that's coming up. But part of that is leveraging the same model that we have today in the sense of putting the user in control. Having the user consent to the information that they're sharing and how that information can then be taken to create a different point of view around cash flow. And I think there were some questions around what type of information is important, and it's things like income. How are you paid? How often are you paid? How are inflows and outflows coming out of the account, and how can that balance? Where is there consistency in the way that you manage money? And thinking about it from kind of an overall balance perspective, it's not just about credit versus cash flow data. It's about an equalizer or complement. People that go and get a mortgage and make a payment every month and are always on time for the last 10 years, that opportunity is represented within their credit report and impacting, what's showing there. But what about somebody who's been renting for the last 20 years? And they've been paying on time. So how are these things able to really serve as a complement or a counterpoint to what's available, and really putting the user in control for sharing that information?
Fantastic. Thanks, Michelle. Okay, I'm going to pop to the next question. John, I think this one is for you. Are the new developments with 1033 good or bad for Plaid, and why?
So first of all, who cares, right? They're good for consumers. That's what matters. Second, they are great for our customers and frankly, good for data providers and banks. These new rules are fantastic for the ecosystem and fantastic for consumers, and that's what matters. But yes, sure, they are also really good for Plaid. We're pretty happy with what's in there. We're going to provide some additional comments, but the most important thing is the CFPB clearly and strongly asserted that consumers have the right to their own data and the right to use it to get a better financial product and service for themselves. That's what we care about. That's what consumers care about. It is a great outcome for us.
That's great. I might add a little additional Raja question, John, on that, which is, how do you think that's differed between before 1033 and post 1033?
I think one of the most interesting things that's coming out in 1033 is sort of how consumer authorization works for permissioning their data sharing. That's an area that Plaid is specialized in, and for over 5 years, we've been doing that permissions management on behalf of our customers and making sure that they go through a really high converting flow, and they have a good UX and a good customer experience with the consumer when they're permissioning their data. I think what's interesting about this rule is now there's going to be regulatory requirements to meet in making sure you do that correctly. And so when you're shopping for that aggregator of who you want to use, you're increasingly going to want someone who is not only delivering like best-in-class UX, best-in-class conversion, high-quality data, but also highly compliant data access so that you know you are safe and your products are safe when you're accessing consumer data.
Yeah, that's great. Okay, let me jump to the next question. When it comes to closing the trust gap with consumers, what would you recommend fintechs focus on in 2024? I might talk a little to this. So I think John highlighted a little of this. I think consumers having transparency in what is happening with their data, I think is absolutely critical. The reality is that there's more opportunities for consumers to do a lot with the evolution of fintech, the utilization of mobile, and more applications that are actually driving value. But with it comes increased vectors for things like fraud, increased vectors for account takeover, for identity mismanagement, things like that. And so I think ensuring that there is utilization of ways to absolutely verify that identity, ensure that when the consumer authenticates, that it's done through a trusted medium, and that consumers actually have control to authorize where their funds go. But importantly, remove connections that don't fit within their schematic or they feel are untrustworthy. I think that's what's going to be really important. And so effectively building out those tools and partnering with organizations, and here's my quick plug, Plaid is able to help you with all of those areas, can be very helpful in closing the trust gap with consumers. And then the last thing, just to highlight, because I kind of really liked that AI insight, which is, I think just having more education for consumers at each and every step of the way is going to be really important, because consumers are increasingly taking actions directly within applications, and they really need to understand what is happening so that they're clear on what they can do next.
Can I just add to that, Roger, really quickly? Because I want to expand on one thought, which is like, nothing gets a consumer more frustrated than fraud. And like we all saw this last summer, right? When Zelle was getting a lot of heat for the fraud on their network. And believe it or not, one of the main defenses was like, oh, well, fintechs are just as fraudy as we are. Like, okay, don't like let someone make that comparison of you. Your customers care about not being subject to fraud. You can share information with each other. You can consume better products from your partners like Plaid to make sure you're driving fraud out of your customer base and out of your ecosystem. That's the number one thing that's going to build trust, is doing everything you can to drive fraud out of the ecosystem.
That's great. Thanks, John. Okay, I think I'm going to direct the next question to Michelle. So how is underwriting changing or de-emphasizing credit scores? It seems the lenders we connect customers to still focus on credit scores to a similar degree as they always have.
Yeah, I mean, going back to my hot take, like, I don't think credit scores are going anywhere. I do think that they are a good assessment of willingness to repay. They're also about, what loans that you've taken out, what history do you have, what consistency have you shown as it relates to a credit or debt related liability. Where I think the opportunity is, it's telling the in between. I mean, a lot of times credit data is 30 days old by the time that that's produced. And how is there information that's happening more recent that can come into play? What's the other point of view that's between the lines? It's not just, did I make my payment, but did I have enough money to make the payment? How am I managing my money outside of those payments when it comes to other standard expenses? And so to me, again, credit scores aren't going away. This is just another alternative or point of view that tells a more complete picture and that empowers borrowers to be able to have that voice a part of what their underwriting process is. And that's assuming that you have a credit score. Again, there's many people out there in the US that don't even have a credit score, whether or not they're thin file and there's not enough data to produce a score, or they have no data at all. And so what this provides is also an alternative to those that have been completely overlooked by the overall credit ecosystem.
Thanks, Michelle. That's great. Okay, so here's the next question is, what would you say the risks and opportunities of open banking are for traditional financial institutions? I might go ahead and start on this one. So we've talked a little bit about ensuring that there is like a trusted way in which data is shared. I think that's going to be critical. But the reality is that the open banking is here and it is here to stay. And I think that's very much present as part of the fintech effects that we've seen. Consumers have overwhelmingly chosen fintech and know that their ability to own their data and be able to provision it where they want to is fundamental to it. And so from a risk perspective, knowing that that's the case, I think the important part for traditional financial institutions is finding partners who they can work with to help advise on APIs and how that data is shared, so that there's so that consumers' credentials are not visible, so that that data is flowing in a way that is trusted, and so that it's powering the right use cases. But importantly, also that just enough data is shared to power the use cases that are important, and that not more data is being shared. So just like a very clear focus on what that looks like. But the reality is, I think the opportunity is actually massive for financial institutions. I mean, the first thing is that consumers have already chosen or are asking for, usage of fintech. And so by not serving consumers where they are, I think that risks keeping the consumer's primary account within the financial institution. So making sure to meet consumers where they are. But honestly, one of the things we've seen is that by enabling connectivity, we've actually seen a deepening of trust with consumers with their financial institution, because they actually believe that their financial institution is serving them in a much more meaningful way. The other piece of this is that we like to kind of think through this idea that, every company is more or less a fintech. And we've seen financial institutions themselves actually start to invest in having some capabilities that fintechs really identified as important for consumers. And so when we think about universal access, from my perspective, we think about this idea that consumer data sharing should not just go from bank to fintech, but that it should also be able to flow from fintech to fintech, or frankly, fintech back to bank. And all of these institutions are able to build products that ultimately result in a better experience for the consumer, and ultimately, I think, creates more business value overall. Okay, I'm going to go ahead and move to the next question. Michelle, I think this is for you. Is the Plaid CRA being aligned with traditional CRA or marketed as standalone? Model/score driven, or just additional information to use with traditional CRA as the user chooses?
Yeah, as we talked about in our announcement last month, the goal of Plaid's consumer reporting agency is to power the view on cash flow based data. So it's not going to look exactly the same as things that you would expect from a traditional bureau, which is typically around, credit history of debt or liabilities. And so this information is going to look different. It's alternative data that serves as, again, as a complement to existing sources within the overall credit ecosystem. And when it comes to model and score driven and, what the user chooses, I think the important thing to think about is the person that chooses what to use to underwrite. It's the lender, it's the creditor. It's who's making a decision on what sources that I can use to underwrite. How do I better understand the opportunities for Raja and make sure that I get him into a right product? And that's where it really comes down to each lender differentiating their bread and butter, and their thing that makes them unique, across different personal lenders or mortgage lenders, is all about how you underwrite and what your underwriting criteria is. And more data and views into Raja and his ability to repay and all of those types of things that come with it creates better opportunity.
Yeah, I love that, Michelle. All right, I think we might have time for one last question. So John, I think I'll direct this to you. I'm going to summarize a few different questions here around
Great.
now and RTP. Hopefully I do a good job, but this has not always been my strongest suit is summarizing, so bear with me. I think the gist is that there are some differences and a lot of overlap between FedNow and RTP. So how should companies be thinking about these two competing rails?
So I think the basic answer is you probably want to support both. The more detailed answer is most likely, and FedNow is still nascent, for community banks, credit unions, more of like the regionals, super regionals, community banks, those folks, they are more likely to be FedNow adopters. The larger banks, the ones that own the clearinghouse, are the ones who have adopted RTP. The other thing to think about is sort of on a use case basis. So there's going to be different limits on both systems for what use cases are approved. One example right now, RTP does not have a permitted use case for e-commerce. I saw someone ask in chat, like, RTP's been around for a while. Why are they only at 1%? Well, like the thing I would most want to do a bank-to-bank payment for is buying something on Amazon, and that's e-commerce, and it's not an approved use case. So you want to look into what use cases each one supports, and then which banks are on which network. The two networks are not interoperable right now, unlike ACH. And what that probably means is ultimately, as you move into payments, you want to be able to support both of those real-time networks over time.
Great. Well, with that, I think we'll call it a wrap. Thank you, everyone who attended. Thank you for joining today's Tech Talk. Michelle and John, just a huge thanks to you guys for taking time to share your perspective. And as always, I think it was some enjoyable banter. Everyone, be on the lookout for the recording shared via email tomorrow. Please be sure to sign up for Zach's annual predictions Tech Talk in January. You won't want to miss that. And we hope to continue our conversation and see you all soon. Thank you all again.
Thanks, everybody.
Thanks all.